Hello, and welcome to the 23rd episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today we are going to have a very interesting session. We will be looking at a follow-up of the current development of the story of the US banking system. We know that there has been a crisis, and also we are getting even newer developments. So before I proceed, I would like to do a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and these will confirm that everything is working just fine. So now that we are through with that part, let's focus on quite a number of things. One is the latest news in the markets. On one, there was a documentary that was released today showing that a lot of Cash App users have been using the application for a lot of criminal activities. And now the SEC is looking to investigate the company. So it's a long sequence where we are seeing a lot of crypto companies in the US that are listed being targeted by regulators. So I don't know whether this is based on their activities or whether it's based on policy to eliminate crypto on-ramp and off-ramp features. So if you look at Square, it was later renamed Block. You'll notice that the stock is down 14.95% today. So this is as a result of the panic that is currently happening in the markets, and the sell-off seems to be continuing. So if you look at Coinbase, it's also something similar. It's down 13.33%. So these are the two, some of the two biggest companies that are allowing American clients to buy and sell crypto. They are both listed in the NASDAQ exchange. And now you can see that the stock is clearly going down for the day. So this is quite a huge margin. And on the good side, we know that there is one stock that has been doing really well. That's NVIDIA. So NVIDIA is up 3.38%, but year to date, since the 1st of January this year, it's up 91.15% based on the innovations that they are making in the AI sector. So that's one of the major highlights. The other highlight is our own criminal here in Kenya. We all know Kamlesh Patni. He pulled off another gold scam in Zimbabwe, and it's among the top news in the markets. So besides that, we also had a couple of news happening from last week through to this week. Yesterday, the Fed went for a 25 basis point hike in interest rates, which pushed US interest rates to 5%. Then today we had two more rate hikes happening in the markets. So the first one was from Canada. Sorry, not Canada, but Switzerland, where they hiked interest rates by 50 basis points, eventually pushing the interest rates from 1% to 1.50%. Then later on, we had the UK sitting in. There was a vote before the rates were announced. 7 members of the Monetary Policy Committee in the UK voted for a rate hike. 0 members voted for a rate cut, and 2 members voted to keep rates at the current level. So, of course, the majority wins. So in this case, interest rates were raised by 25 basis points from 4% to 4.25%. So this is along a sequence that has been happening since March last year, where central banks have been collectively working to remove the excess liquidity within their respective economies. And this is addressed to reduce inflation within their economies. So we know for the UK, inflation spiked higher earlier this week. And this was the CPI on Wednesday, where we're expecting inflation to slow down to 9.9%, but instead it spiked higher to 10.4%, meaning that the Bank of England will be forced to continue hiking interest rates. And this is good for the pound, but bad for UK equities. So similar thing in Canada. For them, they stopped the rate hikes, and inflation is still dropping as predicted. So for them, they don't have much of a problem. But then, as long as the central bank is not going for further rate hikes, then we expect the currency to remain weak compared to other peers where central banks are basically raising interest rates. So looking forward, that is tomorrow, which is Friday, we will be looking at a couple of data announcements. So early in the morning, we'll be looking at the flash manufacturing and services PMI for Australia. We'll be looking at the national CPI for Japan. This is inflation rate, which is expected to slow down to 3.1% from the previous reading of 4.2%. Then we'll have flash manufacturing PMI for Japan, 10 retail sales for the UK, then flash manufacturing PMI for the Eurozone, France, Germany, and the entire Eurozone. Then for the UK, we also see the manufacturing PMI as well as services PMI, and then core retail sales in Canada before we look at actual or overall retail sales for Canada. Then core durable goods orders, and then flash manufacturing and services PMI for the US. So all this data is released by what you call the S&P Global. So the S&P Global will compile data for literally all the countries in the world, and then to release at different times. So we will be having a very good picture of the conditions of services and manufacturing within the major economies. And these will help us estimate economic activity in each of the regions. So that remains the key thing, but the most important news for the day, that is tomorrow, I expect this will be the cost CPI for Japan. So looking at interest rates in Japan is very important since the country has been fighting deflation for decades. So they are looking to achieve stable inflation before they can change monetary policy. So if inflation spikes higher, then we'll be closer to that goal. If it slows down, then we expect the Bank of Japan to continue the same policy of yield curve control, printing even more funds to buy bonds off the open market. And this has the effect of weakening the yen, whereas strengthening equities. So in this case, if inflation flies higher, then we get closer to that goal, where we'll be expecting the Bank of Japan to change its policy. So now that we know what we're expecting for Friday, now it's time to move to our very interesting conversation. Remember, if you have any questions or comments, feel free to type that in the live comment section and I'll be responding to that right away. So hello, Salva, hello, Charles, and Jids. Hello, Sultan. So there's a very nice comment and a request. On the video on how to read energy news, you nimeona see kama currency. So what is basically requesting is that we do one of the webinars focusing on news that affect energy, and we look at how to understand that. It's a really good comment. Thank you. I will be looking into that. So from what we have been seeing in the markets, there was quite a number of reactions. One, for the US dollar index, it fell sharply after the Fed went for a 25 basis point hike. So this is what I would describe as an antithesis. It doesn't go with the ethos that we have been experiencing over the year, where every time the Fed goes for a rate hike, the dollar strengthens and the US equities weaken. So in this case, we are seeing the opposite effect. And main reason is very connected with what happened with the SVB or Silicon Valley Bank. So during that period, that was 2 weeks ago when the banks collapsed, the Fed came in with a new credit line that would provide liquidity to these banks in the US. And this liquidity would be a 1-year term loan that they'll be borrowing from the Fed. And they would back these loans with their existing bonds. And those bonds would be valued at par, not at the current market price, but at what value they would be getting at maturity. So as a result of this new credit line, banks borrowed very quickly in order to save their books. And within 2 weeks, the Fed balance sheet had expanded by over $300 billion. So today, I expect that number to be even higher. And we know that interest rates have been were being raised to control inflation. And at a distant view, we think of it as the Fed cutting its balance sheet. So since last year, it had cut the balance sheet by about $600 billion. And now within 2 weeks, that balance sheet expands by $300 billion. So the net effect is that the Fed is hiking interest rates, but there's still more money flowing within the US banking system. And this is expected to be inflationary. So that's why investors were reacting by short selling the dollar. So for the Swiss franc news, we saw the Swiss franc strengthening against the US dollar. So this is what happened during the news announcement. There was a spike higher, but then for the rest of the day, the US dollar continued. Sorry, there was a spike lower. In this case, the dollar losing against the CHF made some recovery for like 2 hours and then continued pushing further downwards. So if you go to a smaller time frame like the 1 minute chart, then you can see into detail what happened. So a very sharp drop and then a recovery, which traded sideways and then kept pushing lower. So today, the dollar is trading lower against the Swiss franc as a result of the news that were announced earlier today. So for the UK, it's a similar thing. You can see from the 1 minute chart the impact of the news. So in this case, the pound USD is striking higher, pulling back downwards and then making a recovery, pushing even higher. And now it's almost back to where it started. So the overall idea here is that the dollar is currently pretty weak against other currencies. And now other currencies are enjoying these. So whereas at some point in the middle of the day, the pound was losing to the dollar, it managed to recover. And right now, if you compare the price at the open of the day, the pound is trading higher than the US dollar, and this is expected to continue. So there's also a comment about de-dollarization and rupee influx. Hello, Kevin. Yes, you're not late, and welcome to the session. So I just wanted to give you a brief highlight of what has been happening. You can see that all these pairs are at a high against the dollar. New Zealand dollar gaining against the dollar, euro gaining against the dollar, Canadian dollar gaining against the dollar. This one goes downwards. Japanese yen gaining against the dollar and so on. So the dollar has been pretty weak, and gold making an impressive run higher. And there's a good chance we'll be seeing a retest of Monday's high, which is a 2009 price level. So this bullish momentum is expected to continue as long as markets remain uncertain on what might be the full effect of the high interest rates being implemented in the US. So after forming this head and shoulder pattern, there was a pullback, but then a continuation started yesterday and today has been progressing quite well. So I want to introduce you to a Twitter thread here that is clearly very informative. So this is Genevieve from, we call this Great Capital. It's a really good and very informative newsletter. So if you follow it, you get a lot of good insights on what's happening in the markets. So what she's saying is that what happened with Silicon Valley Bank was just a blip compared to the much larger time bomb sitting on bank balance sheets. So here's the even larger issue investors that should be worrying about. So the banking industry increased its exposure to commercial real estate heading into the pandemic. So as you can see from this chart, since 2018 through to 2023, it's a relatively good rising curve until 2021 when it gets even steeper. And you can see US commercial bank loans and raises and how they have been rising, and now currently about $5.25 trillion. So with banks having an overweight position on the commercial real estate investments, then there comes in the risk. So there's a record amount of commercial mortgages expiring this year, and they are worth about $270 billion. So most of these banks are held, most of these loans are held by banks with less than 250 billion in assets, according to the Wall Street Journal. So Silicon Valley Bank's perhaps was triggered by 1.8 billion loss from its bond portfolio. So the losses from the commercial real estate loans that go into default could be much, much higher. So if people are unable to pay for their loans and they default, then those losses could hit the banking books. So Jerome Powell acknowledged a concern for the small banks that hold these commercial loans. And these happened in February. That is during the February meeting. So if a small bank takes on huge losses on a few bad loans, they either need to be bailed out or left to fail. So while massive institutions may be able to make a multi-billion-dollar hit, small banks can't take a proportionately large hit to their business. So 2023 will be a year of reckoning. Commercial real estate investments that suffered in 2020 and 2021 may have been able to stall for a bit, but many of these loans are coming due in 2023. Can the borrowers make good on these loans? Will they be able to pay the loans that they took, especially during the COVID period? So commercial loans are usually much shorter term than residential mortgages, and often have floating rates. So this makes 2023 a challenge. Rising rates, we know that interest rates moved from retail 0 to the current level of 5%. There's falling demand, and this is implies that there will be price declines for commercial real estate. So another key thing to consider is that immediately after COVID, we saw people changing their work environments and companies adjusting to this new reality. So right now, as we speak, I'm working from home, and very many other people have adjusted to working from home environment. And this has the effect of reducing demand for offices, especially in the US. So when there's a lower demand for offices, it means that sales go down and the prices tend to go down, as well as the rental income from such property. So with this hitting the US, if we go ahead and towards some part of the year, we see some people failing to honor their mortgage repayments, then this could translate to losses in the banking books. And we saw that number runs into the trillions. So there is still a large number of things that the interest rates are affecting that are yet to be seen in the markets. So this fear is driving a lot of people to buy gold. We have seen other people buying Bitcoin, among other assets. And this might continue to be a theme this year. So while people are running away from risk, they look for safe haven assets, and gold has been a worthy bearer of safe haven. So we know that since the beginning of the Silicon Valley Bank, the market was trading here. It was on a Thursday. Then it rallied all the way up, making about 11% gain in a very short period. So that's in like 2 weeks. Then it pulled back downwards as people saw the Fed intervening and looking for ways to resolve the banking issue. But now we have a real estate risk, and now people are buying the gold again. And now it's still up 9.85% since this announcement of the challenges facing SVB. So today, we see some further upside happening in gold, and I expect this upside to happen and to retest last year's high. So last year's high was right here. This is a price level of about 2069. So it was about 2069. And also the previous year's high was also something similar. It was around 2075. So we could be seeing gold continue to rally and form even higher highs. And for us as traders, we are looking for such consolidations as this one, so that you can buy onto the next leg, another consolidation, you buy into the next leg, a pullback, you buy into the next leg, and so on. So anytime there's a pullback, there's still some good fundamental information or factors backing up continued uptrend in gold. So that's it for today. Now I'll be looking at any questions that you guys may have. Try to respond to that before we end the stream. So what is causing the dollar to weaken more and more? I've already explained this. There's what you call the BTFP program, where the Fed is providing liquidity to banks. So normally, the banks had bought a lot of long-term bonds at par, and at par I mean that they would be redeeming these bonds once they mature. So they won't be selling these bonds in the open market. So as the Fed kept raising interest rates, the market for these bonds kept going down. So there's always an inverse relationship between bond yields and bond prices. So if you buy a bond and you hold on to that bond until maturity, then you get the full value of that bond. But then if the central bank jacks up interest rates and you want to sell your bond before maturity in the open market, the prices will be really low because nobody wants to lock their money in a bond that is earning lower interest rates. People are more interested with the bond that is earning higher interest rate. So in that case, they will not be buying at the at-par bond at a very fair price. So in that case, you're forced to hold on to that bond. But if you sell, then you sell it at a loss. So in this case, when the Fed realized that a lot of commercial banks were broke, they didn't have the money to honor withdrawals. And if a bank run was to happen to any of the regional banks, then they would definitely go bankrupt. So by providing them this credit line, it means that they can borrow against these bonds rather than liquidate at a loss. So if people go for a bank run and they want to withdraw their money, if the bank faces that risk, it will be forced to sell its at-par bonds. And once it sells, then it takes a loss, but it will have sufficient liquidity to honor withdrawals. So instead of taking all those losses, people moving from one bank run to another, now the banks have sufficient liquidity. We have even seen the Kenya shilling starting to respond to the dollar availability now. But then when you see this kind of thing happening and the Fed expands its balance sheet by 300 billion within a period of 2 weeks, we expect these to be rising, especially now that we have discussed the real estate issue. So if it happens that there are defaults, then the banks could also be having even further challenges, and the Fed will be providing them with even more liquidity, which has the effect of raising inflation or increasing the monetary base. So when this happens, the overall effect is that we continue seeing a weaker dollar, and perhaps we start seeing equities recovering, not the banking sector, but other equities. And this may explain why we have the S&P 500 making a very quick recovery here, the Dow Jones also making a recovery, and also the US Tech 100 or the NASDAQ making another recovery here. So that I hope that answers your question. So there's a question to explain what resistance and support is. This is something we have already done. It's available on the Novice to Pro series. So all you have to do is to go to the FX Pesa channel, search the Novice to Pro series, and then look for the episode that covers technical analysis. I've done that in great detail. Within a period of under 1 hour, you get to understand all the ins and outs of support and resistance. So hopefully that helps. Analysis on gold, I've just done that. So kindly replay the episode if you came in late. Once I end the session, you will be able to replay the session and you'll find that part where we talked about gold. So thank you very much, guys, and I hope to see you on the next session.